Hello friends. Last week we discussed how the indicators in the markets were pointing towards a little bit of uncertainty. And this week we are going to talk about whether the Indian markets have decoupled from the overseas markets. You see, there are always themes, there are always stories, there are always concepts that are floating about in the market. And right now it seems to be decoupling. Have we actually decoupled? Let's dive right in and examine what the weight of evidence tells us. Here goes. The market roundup screen on your screen tells you that it was the Bank Nifty which managed to escape the sell-off. The Nifty 50 fell. Gold and silver fell, silver rather sharply because the US dollar index rebounded. It actually gained. Natural gas and crude oil fell, which provided a cushion to the declines because inflationary fears abated. They withdrew a little bit. Where the USD INR is concerned, it also retreated a little, and that provided certain amount of comfort as well. 10-year benchmark bond yields also eased a little, as did the NSE market capitalization. MWPL went up. We're going to cover that in a greater detail. And in the US market, apart from the Dow Jones Industrial Average, the other two indices fell. Now let's examine whether decoupling has actually occurred. On your screen right now is the daily chart of the US Dow Jones Industrial Average. What you can see is that it fell on 3 out of 5 trading sessions. The rally on Thursday was a spectacular one, and that is the only reason why the US indices have the Dow Jones has basically saved itself the blushes. Now, note how this index has gained only on 2 out of 5 trading sessions, and so have the Nifty and the Bank Nifty. We are going to come to the decoupling part. The death cross remains in place. The 50-day moving average is below the 200-day moving average and falling. What we have seen is a previous swing low pivot of 28,716 proving to be a support, and that's where the Dow has bounced from. Now, if this support of 28,716 is violated again, you could see an extension of the decline. Do note that the index is trading below its moving averages. Now for the Nasdaq 100, this is the index that directly impacts the outlook on our technology stocks. Here again, this index has exhibited a death cross far before the Dow Jones Industrial Average. The death cross remains in place. The price is below the moving averages, and the 11,037 swing low of June is proving to be a hurdle on the upside. On Thursday, it looked like this level could be penetrated, but Friday, the market fell back again. Now for the broadest of all the 3 US indices, the S&P 500. Here again, the swing low of June at 3,640 seemed to have been penetrated upwards on Thursday, but the joy remained short-lived. The death cross remains in place, and the longer the S&P 500 stays below 3,640, the more pressure for the bulls. Now, have we decoupled, or are we just outperforming? Decoupling would mean a complete kind of detachment from the US markets, and whether the US market falls or rises, the Indian market will continue to rise. That's decoupling. And what's outperformance? Relative outperformance. This is something that I have mentioned in my past videos and in my Live Mint column, which I keep sharing on my social media accounts and my Telegram channel. It's a free channel. Please subscribe to that channel. You'll get a lot of pivot points, daily, weekly pivots, a lot of trading tools that would help you earn higher trading profits. So I've talked of relative outperformance by the Indian markets and not a complete decoupling. Decoupling would have been when the US market is falling, the Nifty and the Bank Nifty continues to rise even on days when the US indices are down. That's not happening. But what is happening is, whether it is a day-on-day basis or a week-on-week basis, we are falling less than the US markets and rising a little more in percentage terms than the US markets. So that is called relative outperformance. Decoupling is not something that I am basically looking forward to in the absolute near term. Sure enough, on a couple of days, you might see the US market down and our market could basically close in the green. But decoupling would mean a sustained rally in spite of overseas cues being negative. That seems to be a long stretch. So now that we've taken into account whether we are decoupling or merely relatively outperforming, let's go into the in-house indicators that I share with you every week. We start with the MWPL, which is there on your screen right now. Note how the MWPL has risen after the expiry of the September series. This is along expected lines. Exposure tends to go up, and this is a measure of the two Marshmallow traders' risk appetite. Do note, on the expiry or after the expiry of the August series, within a fortnight, the MWPL had jumped to 30.63%. And now, after a fortnight, we are still at 28.25%. So risk appetite in terms of fresh exposure being created seems to be lower. I'm also factoring in the fact that we are heading towards Diwali. It's a festive season. People tend to set aside some money for shopping, token traditional buying in bullion, etc., etc. But the fact remains that are fewer people biting the bait, and therefore risk appetite is lower. Where turnover is concerned, on your screen, what you are seeing is a week-on-week comparison of the index versus the stock futures turnover compared to the previous week. And do remember, this is a cumulative figure of all three derivative series, that is October, November, and December. Turnover was higher. And do note that higher turnover has come on days when the markets have fallen on 3 out of 5 trading sessions. So the one Marshmallow traders, the intraday traders, have participated in the selling. There's no element of surprise there. That tells you that people are geared up and ready for a fall, and therefore there will be less pain when the fall actually comes. Now for the advanced decline ratio, a deceptively simple metric, but after the price, this is the most leading indicator to bank on. What we are seeing is the advanced decline ratio has eased below 1 as compared to 1.20 in the previous week, which means intraday traders were showing a relative caution and they were not exhibiting very high degree of fresh buying conviction. Now, if you want a sustained rally, this number should stay above 1 along with rising prices. And let's monitor that in real time in the coming week. Now for the basis analysis. Basis is nothing but the premium or discount enjoyed by the future compared to cash. Higher basis shows greater risk appetite. What you are seeing is basis falling both for the Nifty and the Bank Nifty, which means traders, especially bulls, were unwilling to pay a high premium to go long, to buy afresh. That tells you that buying may be there, but it's not as aggressive as it should be in the middle of a derivative series. Now for the impetus chart, it's our in-house indicator. You've learned to trust and respect its accuracy. The impetus has fallen. And the fall is for the second consecutive week, in spite of the fact that the Bank Nifty has logged week-on-week gains. The impetus is down, which means there was not much force in buying. Buying was on very token amounts, and therefore the support that comes at lower levels should have been higher, which it was not, and therefore some more declines may not be ruled out. Now for the LWTD indicator, what you are seeing on Friday, the Nifty percentage gain loss line has moved above zero to close at 1.01, but the LWTD line has remained below zero and actually fallen further to minus 0.86 compared to minus 0.02 in the previous week. Now, the LWTD indicator has remained below zero for the sixth consecutive week. That tells you that buying support on lower levels is rather muted. Ideally speaking, for a sustained up move, I would want the Nifty percentage gain loss line along with the LWTD to rise above zero, but that's not happening. So let's see in the coming week if it happens. I update these charts every single day on my Telegram channel, so do connect with me. The hyperlinks and the contact coordinates come below the video in the description, the pinned comment, as well as in a slide at the end of this video. Now for the footprint of the four market participants, starting with the FIIs. FIIs have basically reduced their index net short positions mildly, but stepped up their stock futures shorts. This is the second consecutive week FIIs have been net short in individual stock futures. Now for the DIIs who've reduced their net short positions in individual stocks, but they've compensated that by increasing their index net short positions. Now, prop traders, these are brokers own trades after insiders. These guys are the most clued on traders because they know who's buying what at what price and in what quantum. So monitoring their moves actually makes sense. While they've increased their individual stock futures net long positions, they've basically gone net short in the indices. And last week, they were marginally net long at 79 lots, but now they're down to short positions with 4,412 lots. Now, let's see what the retail guys have done. These guys have been doing all the heavy lifting after the COVID-based lockdowns were imposed. They've reduced their individual stock net long positions marginally by approximately 14,000 lots. But they've increased their index net long positions by approximately 8,500 lots. So they seem to be a little more cautious as compared to last week. Friends, I now take you through the 360-degree approach that I adopt by showing you the four heaviest weighted stocks in the indices, and their outlook determines where the Nifty and the Bank Nifty will be in the coming week. Starting with the biggest boy of them all, Reliance Industries. Heaviest weightage at 10.84% and relatively good high beta at 1.11. It's basically seen the level of 2,365 acting as a mild support area. And the price remains below its 25-day exponential moving average, which is a proxy for a month-long holding on cost of an average bull. The line itself is falling. So Reliance Industries remains under pressure, and unless it starts trading above its moving average with the average itself pointing upwards, I think it will fail to provide a great degree of support to the Nifty. Now for HDFC Bank, which is the second heavily weighted index component stock with 8.27% in the Nifty, but it is the heaviest weighted stock in the Bank Nifty with 26% weightage. Beta is more or less constant with the Nifty at 1.04, and this stock has basically shown a great deal of affinity or liking for the 1,410 level. It's been kissing that threshold with marginal loss below it and some gains above it, but the price remains below its 25-day exponential moving average, which is a month-long holding on cost. We want the previous swing high of 1,460 odd levels to be overcome on the upside. Price remaining above its moving average with increased volume and open interest to say that HDFC Bank will provide support to the Nifty and the Bank Nifty in a meaningful manner. The third heavily weighted stock, Infosys, with 6.84% weightage and almost at par statistical beta at 1.01. It has risen above its 25-day exponential moving average by closing steeply higher than the average. It was thanks to the gap up open on Friday. Now, the 1,367 threshold is proving to be a double bottom here. We want the stock not to violate this support and preferably trade above the 1,555 level if at all the bulls are to lend any great support to the Nifty. The last and final item out of the four counters, ICICI Bank, 7.94% weightage in the Nifty and 24.97% in the Bank Nifty. This is the second most heavily weighted stock in the Bank Nifty after HDFC Bank. So what happens to the stock also impacts the Bank Nifty. Now, the 836 level is acting like a magnet. The price is going there but bouncing higher from there. It's not violating that threshold. So as long as the 836 level is holding, the medium-term outlook remains optimistic, and the 867 level is a rather short-term threshold to watch out for. It also coincides with the 25-day exponential moving average. If bulls keep the price above 867, ICICI Bank, which is the strongest out of the four counters, might just cushion the declines in the Nifty and the Bank Nifty together. Friends, the four heavyweights done. I now come to the bond market. Believe me, it's the most understated and most ignored aspect of the market. This is the fountain of all money supply for the other asset classes, and the cost of money is going up. I've been telling you this for many, many quarters now. And bond yields have basically edged higher on a week-on-week basis. And I need to see whether the 7.5 threshold is violated on the upside on a sustained closing basis. That would take us closer to the 8% mark. Now, what does it mean for you as a trader in banking stocks, particularly the Bank Nifty? What it means is if bond yields are rising, bond prices have fallen. If bond prices have fallen, there is a mark-to-market loss on the bank's bond portfolios, banks' bond holdings, because banks are the biggest buyers and investors in bonds. So, the higher the bond yield, the more pressure on the Bank Nifty. Do keep that in mind. Don't let anybody convince you that bond markets do not matter to equity traders. Friends, the bond market's done. I now come to the US dollar index. For emerging markets, including India, this is a very critical aspect because the landed price of imported goods, particularly fossil fuels, crude oil and natural gas, depend on the dollar peg versus the rupee. What we have seen is the US dollar index has gained 55 bips on a week-on-week basis. It rose on 4 out of 5 trading sessions. Had it not been for a big prominent red candle on Thursday, you would have seen even bigger rallies on the daily chart. Price remains above the 25-day exponential moving average, which is a proxy for a month-long holding on cost of a bull. The short-term outlook, therefore, remains positive. As long as the price remains above the 111 threshold, I think the bulls still remain in charge, and I would watch this threshold very keenly. Should the 114 mark be overcome on the upside, I think the US dollar index will witness a surge thanks to short covering and fresh buying. Let's take a look at the weekly chart. What you are seeing is a small but noticeable bullish candle with very small wicks. So the weekly range was much more smaller, but it has overcome the hurdle of a 3-week closing high. Last week, I advocated a range between 114.95 on the upside and 110.55 on the downside, which held perfectly well. In the coming week, I expect a range between 115.50 to 111.10. Do keep watching the US dollar index for cues, even for equity markets. Friends, I now come to the Bank Nifty, which was basically an island of strength as compared to the Nifty 50 because it gained 0.33%. It rose on 2 out of 5 trading sessions. But as you can see on the daily chart on your screen, it was the gap up open of Friday, which is solely responsible for the index closing with gains on a week-on-week basis. The price, due to the gap up, has closed above the 25-day exponential moving average, which is a month-long holding on cost of a bull. And we need the price to stay above the moving average as well as trade above the 40,000 round number to rope in the doubting Thomases, the fence sitters, to come out and buy again. And 40,000 must be maintained on a sustained closing basis. Unless that happens, you would see some amount of consolidation. On the weekly chart on your screen, the price is above its 25-week exponential moving average, which is the 6-month holding on cost of an average bull. So the medium-term outlook remains optimistic. What we are seeing is the swing high support of March 2022 at 38,759. We need to close above this. The bulls will have to defend this level in case of declines, and if that happens, the Bank Nifty can possibly rise higher. In the week before last, this index was at number 3 on our most volatile list on our statistical models. But it kind of fell 2 notches to go to number 5. It's not just because the volatility fell on the Bank Nifty. It did do note that the range was smaller, but it was also because volatility or statistical beta rather in individual stocks went up faster. And a higher volatility is a challenge to a day trader. So the challenge has come down a little. Last week, I advocated a range between 40,800 on the upside and 37,550 on the downside, which held perfectly well thanks to the narrower range. In the coming week, I expect a range between 40,900 on the upside and 37,725 on the downside. Do continue to trade light, exercise abundant caution. This is the last week, full trading week before Diwali holidays set in. So traders might prefer to go light, and light markets tend to be a more volatile with the bid and offer spreads widening a little bit. That of course adds on to the cost of trading and reduces your profit margin. So trading light with stop losses makes ample amount of sense. Now for the Nifty 50, friends, which lost almost 0.75% on a week-on-week basis. It rose on 2 out of 5 trading sessions, and believe me, had it not been for the gap up open on Friday that you see on the daily chart on your screen, the losses would have been far deeper. The price has managed to close above its 25-day exponential moving average because of a gap up. We need more follow-up buying before the price can sustain above the moving average, which means the round number of 17,500 assumes a great deal of significance here. We need to go above 17,500. On the downside, 16,794 is a June swing pivot high, and the bulls will have to defend 16,794 or say 16,800 in case of declines. As long as they defend this, we'll continue to remain outperformers to our global peers. Note how the price is below the thick downward sloping red trend line, which marks the tops made after October 2021. For the bulls to gain complete command and come back into the driver's seat, we need to go past the 17,650 odd levels, and that is the challenge that faces the bulls. Where the weekly chart is concerned, the price is precariously poised at its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. So the correction that I was telling you, thanks to mean reversion, the price coming towards its moving average is already here since the last 3 weeks. We ideally should stay above the 25-week exponential moving average. Otherwise, the medium-term bulls will start to get tired. So keep watching the level of 17,100 odd as the 25-week exponential moving average. Friends, in the week before last, this index was at number 9 on our in-house statistical beta list, but it fell 2 notches to go to number 11. Here again, volatility of the Nifty itself was lower, but individual stock volatility rose higher. Therefore, it fell 2 notches, which is good because lower volatility means a smaller challenge to day traders. Last week, I advocated a range between 17,875 on the upside and 16,750 on the downside, which held perfectly well. In the coming week, I expect a range between 17,750 on the upside and 16,625 on the downside. Here again, please trade light because I expect exposure levels to remain curtailed. Diwali coming up and volatility and bid and offer spreads, which is a big deal for me as a day trader because it adds on to the cost and eats into my profits. I expect bid and offer spreads to go wider in the week ahead. Friends, the index chart's done. I now come to the risk appetite of the retail trader, which I measure by what component of the total F&O turnover is contributed by options vis-a-vis futures. If at all retail traders show higher risk appetite, they will take bigger exposure in futures because higher degree of capital outlay, span margins, mark-to-market, etc. are involved. Look at the sky blue line. It is clearly showing peaks of multi-weeks, which means the stock options turnover went up. Now, stocks are more volatile as compared to indices. So, number one, higher degree of involvement in stocks tells me that risk appetite was higher. And the olive green line is the stock futures turnover contribution. Here again, it's at a multi-week high. That means the risk appetite was higher because futures turnover contributed a greater degree of the total component, total turnover contributed in the market. Do remember, last week, the overall turnover was itself higher. So risk appetite is there. The bulls are attempting to fight the bears, but they need to continue to provide follow-up buying support for the outperformance to basically continue. Friends, I now come to the most popular segment for statistical model traders, wherein I give you 5 stocks that have gained the highest amount of impetus on Friday. So you take a small exposure, wait for large price moves to make your money, and 5 stocks that have lost the most amount of impetus on Friday. So on Monday, you take big exposure, wait for small price moves. This is good for scalpers. This list is valid only for Monday. If you need to be updated with this list day on day basis, please subscribe to our free Telegram channels. You're missing out a whole lot of trading tools that I provide for free for my online family, and you can avail of these tools on a day-on-day basis. So I start with statistical beta gainers. List is led by SBI Life at number 1, Divi's Lab at number 2, Hind Hindustan Petroleum at number 3, Whirlpool number 4, and MFSL at number 5. The statistical beta losers list is led by Granules, number 2 Torrent Pharma, number 3 CanBank, number 4 Zydus Life, and number 5 Sun Pharma. A lot of pharma stocks here. I repeat, please subscribe to our Telegram channel. You can get this list on a day-on-day basis, Tuesday through Friday. Friends, I'm always eager to hear from you about your trading experience and how my videos help you garner higher trading profits. So please keep your comments and your feedback coming. I eagerly look forward to them. Before I sign off from this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here, and help me reach out to fellow smart, like-minded subscribers by sharing my video with your family and friends and your social media groups, your WhatsApp groups, Telegram groups, etc. Thank you for your patience in being with me in this video. Till we meet again in my next. This is Vijay Bambwani signing off for now. I wish you have a very, very profitable week ahead. Thank you.